callers at 11, and then anonymous 911.
Ready? Okay, good afternoon, everyone, and I'm gonna call this investment meeting to order. And we'll start off with the roll call. Today is May the 16th, 2024, and it's 4:36 p.m. Okay, roll call, Sue.
Angela Banks, Christina Bennett, Phyllis Cross,
Present.
Sheila Goodwin,
Present.
Emily Hubbard, Shanice Johnson,
Present.
Yvette Levy, Martel Mann, Bobby Richardson, Albert Sanders, Doris Walker.
Present.
We do have four. We have four.
Okay, so I'll just turn this meeting over to Sue and Weldon, Jeff, and Allie, and let you all go on and get started with the business at hand. And thank you all for your attendance this evening. We know it's the end of the school year, and a lot of things are going on. A lot of things going on, even if you're not in the schools. And welcome everybody.
Well then, Jeff, kick it off.
So the first thing I think we have on the agenda, I believe, is Lazard, is your emerging market debt manager. We're starting to set up meetings with the managers so you can get acquainted with them, what they do for you, for the system. Also, in this particular case, Lazard also is one of the managers been flagged and for watch. They are three of the criteria out of the four. They are not meeting, so this is very time appropriate that they come in and present, and they should be in the waiting room now, so if you can let them in. They have a total of 30 minutes to present, and please feel free to ask questions during their presentation.
Okay, I'll let them in.
Thank you.
Hey everyone, can you hear me okay?
Yep, you're a little faint at first, but we got you now.
Great. How are you, Sue?
Good, how are you all?
I'm well, thanks. I have RF Joshi with me as well on the line. I'll introduce RF shortly to those who have not had the pleasure of meeting him yet, but I just wanted to quickly introduce myself. My name is Michelle Donnelly. I recently took over your portfolio as a primary contact at Lazard, so really excited to meet you all over video and hope that perhaps one day we can come meet you in person. I've had the pleasure of meeting Sue over video and just some really, it's really great to connect with you all. Before passing it off to RF, which I will do in just a moment, I just wanted to provide a very quick firm update. So as of 3/31, as I'm sure you may have seen, we released our earnings and AUM is at 210 billion. That includes both asset management and advisory, the two sides of Lazard. This is up, so those numbers are up 2% from the fourth quarter of last year and 7% from the first quarter of 2023. Which we attribute to, a strong market and strong returns. Does everybody have a copy of the presentation, or would it be helpful if I shared it on the screen? Sorry, I actually see it on the screen.
Yeah, and just let me know when you want me to move forward. It was sent out to everyone, but we can have it here too.
Perfect. I see it on the screen now. I see it clearly. So I'm happy to address any questions if you'd like, but I will pass it off to, again, RF Joshi. He's the co-head and portfolio manager for our emerging markets debt team. And without further ado, unless there are any other questions.
And you have a total of 30 minutes for presentation, so.
Okay, great. Thank you. Thank you very much. And good afternoon to everyone on the call. My name is Arif Joshi. I am the co-head of the emerging market debt team at Lazard. Given the time, I am going to focus on about 8 or 9 slides within this presentation to give you the key highlights. About half the presentation is going to be on what has happened over the last year and over the last quarter, and the other back half of the presentation is going to be on what we expect over the next 6 to 12 months. What are the key risks? What are the expectations for overall portfolio returns? So let me start with page 3. So this is an overview of our team here at Lazard. So we manage just around $9 billion dedicated to emerging market debt. So that means we are buying emerging market bonds and emerging market currencies from countries around the world. So that's across Africa, Latin America, Eastern Europe, and Asia. We manage both strategies that are long only, meaning we buy bonds and we're measured against an index. And we also manage a strategy which you are invested in, which is the total return strategy. And what's different about the total return strategy versus all of the rest is when we believe that there is not a lot of attractiveness in the market, we're not getting compensated for the risk that we're taking. We do have the ability in the total return strategy to significantly decrease risk and protect in times of significant volatility. So it is a more flexible strategy than the rest of the portfolios that we manage. And it also tends to have the least amount of drawdowns during bad times. So it is a much smoother path as you are invested in emerging markets. And that's why it tends to be an attractive place for foundations, endowments, and institutions to invest in. So out of the $9 billion that we manage in emerging market debt, there is approximately $2.4 billion invested in this total return strategy. Let me move to page 4. So this is an overview of our team. Our entire team is based here in New York. We're located in Rockefeller Center. As I mentioned earlier, I'm the co-head of the team, along with my colleague, Denise Simon. Denise and I have been working together since 2001, so just about 23 years now. We've been at Lazard for 14 years, so we were hired by Lazard to start the emerging market debt franchise here. Denise and I are ultimately responsible for deciding how much risk we're taking in this portfolio. We are responsible for deciding whether we want to be in dollar-denominated debt or emerging market currencies. And we are ultimately responsible for deciding where emerging market is relative to the United States, to Europe, and to the rest of the developed world. We then have portfolio managers who are responsible for picking the specific countries that we're invested in. Sergio is responsible for dollar-denominated country bonds. Felipe is responsible for currencies and local markets. And then finally, Adam is responsible for corporates in emerging market countries and deciding where to invest there. One note I'll make about our investment process. So it has not changed much in the last 20 years from the perspective of our job is we go and meet with policymakers. So in emerging market countries, that is the finance minister, the head of the central bank, the prime minister or the president, and then the CEOs and the CFOs of the largest companies within those countries. So we either meet those policymakers in New York when they come through, down in Washington when we go to the IMF meetings, or when we go meet with members of the US government. And then we spend quite a bit of time in these countries, meeting in their capitals with the various members of government. We meet with both the members of the current government. We also meet with the opposition members. And the output from all of these meetings is we are trying to determine, is the policy that is in place for each one of these countries the right one for that country? And do we believe that that country is on an improving trend or a deteriorating trend? And are we getting paid adequately for taking the risk of that country? So ultimately, that is what we are trying to decide. And so that means that oftentimes there are countries where we will be invested for 5, 6, 7 years if we think it's structurally improving. In other cases, we will have shorter term horizons if there is a particular risk event ahead of us. So that is the work that we do on a bottom-up basis in picking emerging market countries. We also have to keep in mind how these emerging market countries are affected by what's happening in the United States specifically. And what I mean by that is a very important input to our process is what the US Federal Reserve is doing. As the Federal Reserve tends to be the central bank of the world, when the US Fed is hiking rates or cutting rates, that has a significant effect on other countries, sometimes negative, sometimes positive. If the United States is growing well above how fast it should be growing, that often has an effect on other markets, either through commodity prices or through overall flows of money in and out of the United States to those other countries. So really what we try and focus on is bottom-up policy work, and then we apply that in terms of a valuation framework for each one of these countries. Let me move straight to performance, which is on page 7. Okay, so let me start with the longer term performance, and I'll make a couple of comments here, which is what this strategy is supposed to do is we are supposed to deliver you asset class or better performance with less volatility. It is supposed to be a smoother path over time. So when you look since inception, we have delivered the asset class with less volatility, about 20% less volatility. However, 2023, in our view, was a poor year for us. So yes, the portfolio was up 7.8% on an absolute sense. So we did make money for the portfolio. However, our asset class was up 11.9%. And so what that means is we only captured about 2/3 of the returns from our asset class. So why was this the case? Very simply stated, we did not take enough risk last year. So while there were many opportunities within emerging markets last year, we were particularly worried and concerned with what was happening with regards to the United States, largely in the second and third quarter of last year. So if you remember back to last year, we had inflation going up significantly in the United States. The Fed was hiking rates at 50 and 75 basis point clips. And in March of last year, we started having regional banks which started to fail. And from our history of having managed through COVID, through the global financial crisis, through the taper tantrum, all of these risk events over the last 20 years, normally when you get stress in the banking sector, there is a very high probability that that starts to spread throughout the financial system of the world. And so we reduced risk significantly in March, April, and May of last year because we were concerned about the spillover effects into our emerging market countries. And in retrospect, we never got that sell-off and we never got that spillover of risk into global markets. So we did not participate in the rally that you saw in the third quarter of last year. It wasn't until the fourth quarter when we added risk back into our portfolios that we were then able to capture returns both in the fourth quarter. And as you can see in the first quarter of this year, we're back to outperforming overall markets. So the fact that we underperformed last year, we were about 4% below what the asset class did. That drags down our overall returns when you look back over the last 1 or 3 years. In terms of the first quarter of this year, the asset class is slightly down through the end of March. There's been a nice rally, obviously, that you can see in markets over the last month and a half. We have fully captured that rally. So the portfolio is up nearly 2% as of the close today versus the asset class, which is up about 0.75%. So we have nice outperformance to begin this year, both on a relative and an absolute basis. Let me move to page 9. Okay, so a couple comments here. Let me start with the risk budget usage on the bottom half of this graph. So this goes back over the last 10 years, and it looks every single month, how much risk are we taking? And the black line is the overall risk number. And so what you can see from this is that our normal level of risk taking is somewhere between 60 and 80%. So the reason why you invested in emerging market debt is because there's a lot of yield in our asset class. There is much more yield in emerging markets than you can typically find in the US, in Europe, and Japan. And the reason that you're getting paid all of that yield is because it's more risk. So you're counting on us to make sure that we are investing in these countries, that we're not taking too much risk, and we're able to generate that yield over time. So it is very rare for us not to be fully invested in emerging market debt because we don't want to give up on that yield. What I mentioned earlier about last year, you can see that in March and April of last year, we significantly reduced that black line. That's the overall level of risk. And again, in retrospect, that was a mistake on our front. We should have kept the risk as high as we did. But to be fair, there were a lot of warning signs for us that there could potentially be problems down the road. And then you'll notice as we got to September and October, once we had cleared that risk event, we got back into the market in a pretty sustained way. And we have been running somewhere around 80 to 93% of our maximum risk ever since. And so what that's translated to mean is that we are finding many opportunities for the last 4 or 5 months in emerging market debt. We believe that we are being more than compensated for the risk that we're taking in emerging market debt. And more importantly, if you look at the upper left-hand corner, we are generating this high level of yield, which as of the end of March was 7%, without taking a lot of US Treasury risk. So we're not generating this yield by going really long into 10, 15, 30-year maturity bonds. We're actually doing it in 5-year maturity bonds, and we're still able to generate that kind of yield. So that means that our sensitivity to treasuries and to US inflation is significantly lower, and we're simply able to clip that coupon and continue to wave in the 7% yield across our asset class. Let me move to page 10. So there are two places that, or two ways that we can invest in emerging market debt. Either we buy dollar-denominated bonds of emerging market countries. So there we are not taking currency risk. Or we can buy the local bonds of those same countries where we are taking underlying currency risk against the US dollar. So this slide shows dollar-denominated bonds from these countries. These are bonds where we're not taking currency risk. And what you'll see is that it is a very well-diversified portfolio. There are about 30 different countries that we have pretty sizable positions in. And you won't see any country on this list with a position size greater than 4%. So we've nicely diversified across, and that's because we're finding opportunities in all segments of the world. There are really only 2 places which we're quite bearish on, where we have no position. One is China, which is a big part of emerging markets. We have a 0% position in China. And in fact, more recently, we've actually gone short China. So we're shorting the Chinese currency, the renminbi. And our view there is that China, in our view, remember, we're always looking at policy in these countries. We believe that China is on the incorrect policy path, that growth will continue to slow, that with the additional tariffs, both out of the Biden administration and either Biden or Trump in the next administration, those will continue to put China at a disproportionately negative competitive stance against the rest of the world. And so we do not think that we are getting paid anywhere close to what we need to take Chinese risk. And that has been the case now for about 2.5 to 3 years. And I imagine when I think out over the next 12 months, it is highly unlikely that we will take a long position in China. We also don't have any Russia. We exited Russia after the Russia-Ukraine war. Again, there are far too many uncertainties with regards to Russia, not to mention significant issues on overall governance in that country. And so we haven't had a position there in a number of years. We don't intend to have a position going forward. On the positive side, I'll just mention a couple countries here, maybe Oman in the Middle East and Argentina in Latin America. So unlike what we see in the United States, where we have very large fiscal deficits, we run about a 6% fiscal deficit here in the US. We run about 104% debt to GDP in the US. So we all know that fiscally, the US has been on a deteriorating track for a long period of time. In a country like
hold on a second. Are you open for, someone has their hand up, the chairman of your committee? Can you answer a question now? You want to wait?
No, go ahead.
Go ahead, Christina.
This is Christina Bennett. So I had a question for you. So is you exiting Russia or shorting China, does it really have a lot to do with our domestic policies as well, especially in red states where legislatures are really looking at pension plans, DB plans to look at their exposure to China?
Yeah, so the short answer is no. It's really because of the policy. China is one of those examples where, not to get too nerdy here, but we are always looking at the three ways that any country can grow. It's through population, meaning labor force change, it's through capital spending, and it's through productivity. Those are the three ways. And it happens to be in the United States, we do a really good job on immigration, on capital spending through deregulation, and on innovation. You're seeing a lot of innovation through AI and all of those other things. That is the large reason why the US has been so successful in growth for 14 years. China's in the exact opposite scenario. Their labor force has been declining for the last 6 years. They are pushing foreigners out of their markets. They have negative foreign direct investment. And in fact, productivity is not growing at the same pace that it is. So when we look at those actual policies that they're implementing, those are negative policies for that country, which is why we ended up getting out of China a while ago.
Okay, thanks you.
Sure. So very quickly, I'll talk about Oman and Argentina here. So Oman is obviously benefiting quite a bit from their position in the Middle East. They're an oil exporter, they're a natural gas exporter. The real question is, what does a country do when they get these windfall profits? And what Oman has decided to do is use all of their profits to pay down debt. So about 4 years ago, they were running debt at around 63% of GDP. Today, they run debt at 33% of GDP. So when we look at a country like that, and remember, we're bondholders, we're debt people, we are very satisfied when a country takes a much more conservative path in terms of the management of their overall fiscal and their overall debt. So that is one of our largest positions. We strongly believe that Oman is going to be upgraded to investment grade. And as a result of that, we're going to get outsized gains as a result of very good fiscal management. On the opposite extreme is a country like Argentina. This is a country which has defaulted 6 times in the last century on their debt. And policy has been horrible there. Huge fiscal deficits, printing of money, inflation. And to their credit, and this was because of an election change, they have a new president that came in December. They made it a law in Argentina that they can no longer run a fiscal deficit. So this is effectively like a balanced budget amendment. They no longer print money because they don't have a fiscal deficit. They are opening themselves up to foreign direct investment. And we are starting to see the reserves of the country improve only in the last 3 to 4 months. So we think Argentina is on a positive trajectory. And we continue to meet with the president, the finance minister, the head of the central bank to make sure that we're checking that progress and they're continuing on that track. Okay, I have 3 last slides. Page 12. So I talked about investing in dollar-denominated debt. On page 12 is local currency debt. So in local currency debt, we're actually taking currency risk. And that currency risk is always against the United States dollar. So the two of the largest positions that we have are in Latin America, both Mexico and Brazil. If you followed Mexico at all, they are the biggest beneficiary in the world to reshoring away from China. So if you go to northern Mexico, within 50 miles of the US border, the unemployment rate is 2%. There is very little capacity amongst all of the warehouses and manufacturing. That part of Mexico is absolutely booming. So you're seeing remittances into Mexico up significantly. You're seeing foreign direct investment coming into Mexico to build up capacity, either from the US automakers, also from people getting out of China and moving to Mexico. And that's been very beneficial to the Mexican peso. So as all that money flows into Mexico, the Mexican peso has been appreciating significantly. And that is why we have a substantial position in Mexico. It's a similar story in Brazil, where you're also seeing investment coming into Brazil in both their equity and their debt markets. We are a little bit more concerned in Brazil over the last couple of weeks. They've had flooding in southern Brazil, which is going to hurt overall growth. We're also a little concerned about the additional fiscal spending. So it's highly likely that will reduce the Brazil exposure going forward. But overall, we are getting paid extremely high yields, 10% in Brazil, 10.5% in Mexico, to have investments in those local markets. And I will wrap up with two topics. Page 21 are our base cases and our risks for the next 12 months. Okay, our base case is we are looking at spreads coming down. That means that we're getting paid too much to take risk today. So we think that will normalize and that will be additive to the portfolio. We also are expecting US Treasury yields to come down to just above 4%. I put together this presentation at the end of April. We've actually already gone from 4.65 down to about 4.35 over the last couple of weeks. So we're generally heading in that direction. Those two will be additive to overall returns. And then on top of that, we're generating a 7% yield. So when you combine the effect of emerging market yields going lower, US Treasury yields going lower, and the 7% that we're clipping as a coupon on this portfolio, we are expecting over the next 12 months, low double-digit returns from emerging market debt. So it's rare to have that high of an expected return. Normally you get 6 to 7%. You generally get your yield in this type of asset class. So we are particularly bullish today. That is why we are running as much risk as I showed you earlier in the presentation. How could this go wrong? Well, there are really three scenarios, and they really are dependent on what happens in the US. So there's actually, the stories in emerging markets are very positive. Better economic policy, both on fiscal and at the central bank. Growth is starting to go higher. Commodity prices are supportive. Trade looks good. The risk is really around what type of move we get in United States growth. So I listed three risks here. Risk number one, which is the highest probability risk, but still not our base case, is that inflation stays high in the United States. And as a result of high inflation, the Fed actually cannot cut rates. They cannot cut before the election. They cannot cut after the election. And the result is that Treasury yields don't go lower. They, in fact, go slightly higher. And the result is that the risk of emerging markets goes slightly higher. But what's important about that scenario is the yield, the coupon of our asset class is so high that even in that scenario, we still will be able to generate a positive return because of the yield. And so we're looking at about a 6% return in that type of scenario. The second risk is that we actually get a recession in the United States. Again, it is not our base case. There are very few indicators in the United States that would suggest that to happen. But if that were to happen, what normally happens is Treasury yields move down significantly. The Fed cuts rates significantly. And the riskiness of the stock market and emerging markets go up. So you lose some of your capital on that side. When you add that all together and you still get the coupon, then we get down to a 3% return for our asset class. So it's still positive, even in that extreme example, again, because the yield is so high. So the single worst event that could happen to us is that, in fact, inflation is not just sticky, but it goes significantly higher. So this would be a late 1970s type of scenario, 1978, 1979, that the Fed is not done with its interest rate hikes, that they have to hike a lot more. And in that type of scenario, then unfortunately, yields around the world go up significantly. It causes rolling defaults across high yield United States, across emerging markets. That would be the worst possible event for a fixed income investor, because then not only will you have capital losses, but you'll actually have defaults in the portfolio. So in that type of environment, we would expect to lose 10%. If you were to ask my probability today, I would say our base case is at around 65 to 70%. Sticky inflation is closer to about 15%, and then hard landing and inflation reaccelerating is below 10% on both. So that is why we're comfortable, once again, running this type of risk. The final slide, as I'm running just at my time limit, this on page 22, is the United States market. This is critical. So the left-hand side here, these are the only two pieces of data that the market cares about. So this is Wall Street, what Wall Street cares about, not what Main Street cares about. But this is what is going to drive the Fed. The left-hand side is the jobs number. The right-hand side is the inflation number. The jobs number comes out on the first Friday of every month. The inflation number comes out somewhere between the 12th and the 15th of every month. On the left-hand side is the jobs number in the United States every month for the last year. And the story from March of last year until November of last year was a gradually declining jobs market from very high to normal to slightly below normal. And that is why in October or November of last year, the Fed told all of us that they were finished their interest rate hikes. And the equity market went significantly higher and the bond market did very well. Then what happened was the jobs market started to get stronger. So you can see November, December, January, you see, and then really high number in March, you see jobs picking up from under normal to above normal. And what happened in those months is suddenly Treasury yields start to go higher because we get worried that maybe the US is expanding and not coming back down to a normalized pace. So the jobs number that came out about 7 or 8 days ago, which is what I show in that downward arrow, was critically important. It was the first number that we've seen in quite a while that shows a decline back to below normal levels. It changes the path that we had seen over the last couple of months. And it suggests that the United States is not running hot in terms of the economy and in terms of jobs growth. It's actually running right about normal levels, plus or minus a margin of error. That is exactly what the market wants to see. That is why the equity market is hitting record highs today. That is why the bond market has been doing particularly well. And that's very helpful for us in emerging markets because it means that we're not as worried about a too hot US economy then affecting treasuries. And then on the right-hand side is inflation. And this is what all of us have been talking about for the last 2 years. Inflation gradually was going lower over that exact same time frame, March of last year till October, November, and then it started going back higher. I did not update this for day before yesterday's number, but what we found out day before yesterday, it was actually yesterday. The number yesterday is that inflation is heading back down. It was a very good number that came out in the United States on Tuesday and Wednesday. And so when the official number comes out at the end of this month, you'll see that coming back down to about a 3% run rate on inflation. And so that is also encouraging to us. We need to see more of it for us to at least be able to say with a high level of conviction that we are past the worries of inflation and growth in the United States. So when I put that all together, we are positive bottom up in emerging markets. We have about 30 to 35 countries that we are bullish on We've diversified your portfolio across those countries. We are running top quartile levels of risk, which means if the market goes up, we are going to outperform in those countries. Our worries are very much around the tails in the US economy, either too hot or too cold. As long as we're staying within this general medium level range, that is very beneficial for non-United States investments. And that is where the portfolio is today. So let me stop there and see if there are any questions.
Thank you very much.
It was a pleasure. Thank you very much.
Thanks, everyone. If there's any
Also,
follow-up, we can
what is the
combine.
fee structure?
Sorry?
I missed the fee structure.
Any here?
The fees.
The fee that you're paying?
Yes.
I can follow up with that information. I can pull that together for you and send it back to Gwelda or Jeff or Sue. Would you like I can follow up with you guys?
That's fine.
Christina, we can cover that in the quarterly report as well.
Sure. Thanks. I appreciate it.
Thank you.
Thank you all for
Yeah.
being here.
Thanks, everyone.
Thank you.
Bye-bye.
Okay. So, Sue, you give us direction on how you want to do this, because I know we have the proxy discussion. Do you want us to do the performance? How do you want us to do this?
Do you want to go into executive session?
What's it?
You want to go into executive session?
Yeah, I was gonna say, if we want to do the proxy discussion, I think, we could go into closed session. Do that now. And then come back for the reporting,
Okay.
if that's okay.
Yeah.
All right, so let me.
And Christina, while we're doing that, the fee on the Lazard fund is 75 basis points.
I said, okay, I was on mute talking to myself.
So we're voting on to close the meeting?
You need a motion on number one there.
Yeah.
Okay. I make a motion to close the meeting and that all records and votes to the extent permitted by the law pertaining to and or resulting from closed meeting be closed under PSMO 610-0211 for the purpose of having a confidential or privileged communication on legal matters.
Richardson.
Goodwin, second.
Would you like me to take a roll call?
Chris, the floor is yours now. I was just standing in until you got here.
Go right ahead.
Okay, roll call.
Christina Bennett,
Yes.
Lois Cross,
Yes.
Sheila Goodwin,
Yes.
Shanice Johnson,
Yes.
Martel Mann,
Martell, are you there?
Yes.
Bobby Richardson,
Yes.
and Doris Walker.
Yes.
Have 7, motion carries. So take just a few minutes. off yet.
So Sue, we will take direction from you or Mr. Process, just how much you want us to do, because we're at 7 o'clock or 6 o'clock there. Let me know, let us know how much you want us to do. You want us to do the quarterly report, or you want us to do the update, April, what would you like us to do?
So, what do we want?
It's pleasure of the trustees. We are live again,
We
so
are live again, so
we have both a quarterly report, the first quarter report, and then we also have the April performance report.
so what's the pleasure of the trustees? Do you all wanna take a vote, or do you wanna just? Okay, if that's the way you
I
feel.
vote to take a vote.
What will we be voting for?
You want us to give
What?
us a report where it will be like at least another 30 minutes? If you want us to give an abbreviated version, we'll just give you the high level return.
Yeah, I like the high level of both of them.
I'm with Bobby.
Bobby, what did you say?
The high level of both of them, very brief.
This is what we call the 2-minute drill.
Yes.
Okay. All right.
Do you want to start with the quarterly or?
I'll take the quarter. They won't take long. You all have already seen this. You've seen the high level numbers, and I'll only focus on a few pages here. Sue, if you can turn to page 13, which is the pie charts, so you can see where you were dollar-wise. I'm not going to go over the market environment. We're halfway through the second quarter. So here, as you can see on this page, all of the triangles are within your ranges. So you're within the allotted ranges for each portion of the fund. So we're not in violation of our asset allocation. So if you can turn to the next page, which are the pie charts, just let you all see where you were at the beginning of the quarter, dollar-wise, and where you are now. As you can see here, the fund at the beginning of the quarter was $842,315,560, and a nice gain with the market going up at 857,979, 609. This is where you were as of the end of March 31st. If you'll go to the page number 13 and 14, there was some question regarding the fees. You can see here all the fees are outlined, and you can see there's a Lazard fee as Jeff stated, was 75 basis points for the assets that you have with them. So all the fees are in line. No one's over where we would expect it to be for the specific asset class. If you turn to page 16, so this is an important page. You can see here, all the managers are meeting the stated goals within the respective asset classes regarding commissions. Everyone has met or exceeded the percentages that we require in the different asset classes. So no problems there. We've only got everybody in line with that. So if you'll turn to page 18, the bottom of this page, you can see the cash flows for the time period, where you started out dollar-wise, about contributions about $9 million, 26 in distributions, management fees of $192,586, other expenses of $13,008. Capital gains, this is a big number here. This brought the $32.9 million in capital gains. This is paper gains. So that's how you ended your market value at the 857,979,609. And then the important page, you'll turn to page number 25, 25. High level, as you can see here, the fund did very well in the quarter, with exceeding the policy index at 3.97 versus 3.66. Over the past year, not quite meeting the policy index, 11.8 versus 12.1. A nice return, but not as strong as the peer group. The long-term returns since inception are around 7% at 6.8. Whereas the policy index should exceed the policy index with a return of 6.6 during that time period. What I will say on a high level here is the domestic equity managers, most of the domestic equity managers met their goals. The portion that was a little off, as you'll see, we'll go in here a little bit, will be in large cap value. We look at large cap equity. The core manager, of course, is an index. That's fine. Where you saw some weakness here is Edgar Lomax, 8% versus 8.99. Edgar Lomax is a deep value contrarian manager. Even the value components, according to them, in the index had growthier, less dividends. So as a result, they don't perform as well. Not a bad return, but below the Russell 1000 value. And they did not perform as well as their peers, ranking 77. Long term, they have had mixed performance versus the Russell 1000 value, but they're not keeping up with the peers or other managers in that large cap value space. They will be coming into the visit with the fund and to give a report in the August meeting. They're expected to appear virtually in the August meeting. So if you can move to the next page. I will say here, the rest of the managers, for the most part, have done a great job. We actually split the dollars in the growth component. As you can see, with TCW, who's your active large cap growth manager, has performed well, delivering a 13.6% return over the Russell 1000 growth, which is 11.41, and this ranked very well in the peer group at 28. The longer term returns are a little bit more challenged when you look at that 3-year mark and beyond versus the Russell 1000 growth. But if you look at the peer group rankings, they're pretty much in line with the median, despite the below in the 3-year, and that's because of the concentration of that benchmark in the shorter term periods. But they have in long term, even with that being said, they delivered almost a 60% return since inception of 2012. Drill down a little bit. Your small cap, micro cap managers, both Westfield and Systematic, had really good quarters. As you can see here, for both of them, they both exceeded their the Russell 1000 growth and the Russell 2000 growth and Russell 2000 value. And as you can see here, Westfield has exceeded that benchmark in every time period measured, with the exception of a 3-year. And they're either at median or above median in all time periods. So they've done a great job long term in the small cap growth space. Systematic, as you can see here, has almost 500 basis points of excess return over the Russell 2000 value, ranked very well at 22nd. And if you look across the board there, this manager, since their inception in 1999, they have delivered significant outperformance versus their benchmark and ranked very well versus the peers in all time periods measured. The microcap manager, DFA, did not perform as well and ranked 72nd for the quarter. Even though in the longer term periods, the manager has done well versus the benchmark. Only just a little weakness in that 1-year time period, 19.74. In the peer group, but exceeded the return of their benchmark in all time periods measured. We go down to international. You can see here your growth manager, which is Fidelity, delivered a 5% return in the quarter, not exceeding their custom benchmark, a little bit below median. If you look at the longer term return for Fidelity here, you can see, with the exception of that 3-year period, the 3-year, 1-year period, they are slightly below the benchmark. The longer term numbers are stronger versus the benchmark, but they're not doing as well as other growth international managers in the 5, 10 year inception period. Causeway is a value-oriented manager. As you can see here, growth, as you know, has been very strong, not only domestically, but internationally. As you can see here for the quarter, 3% return, ranking 63rd over the past year. Although not wrong as the benchmark, still a 15% return, but ranking well versus other managers that manage like them. And if you look at the longer term numbers, the numbers are strong versus the benchmark as well as the peer group. Thanks to the next page, Sue. Emerging markets. You've got DFA and Invesco. DFA is more value, Invesco is more growthy. As you can see here, the DFA portion of the fund, DFA portfolio, you can see here has delivered excess returns in every time period measures versus their MSCI Emerging Markets Index. It had actually relatively good numbers in the peer group with exception to inception number. Invesco Emerging Markets has had a little bit more of a tough time, and they're one of the managers that is on watch in the fund, and we will have them coming. We've got to schedule them coming in later on in the year, but that manager has had a little bit more tough time, albeit on the since inception of 2014, they have exceeded the MSCI Emerging Markets Index, but ranked not well versus peers that long-term period. Let's Exponence. As you know, we've had some challenges with respect to some of the markets there, but I would say Exponence in general has done well for the quarter, slightly below, but over the past year, 20.5% in that managers segment of the market. Let's see, move on to fixed income. No concerns with respect to fixed income. As you can see here, both of your core managers did a great job in what was a very tough market for fixed income. As you can see here, fixed income was actually positive when the benchmark as a group, 0.14 versus 1.94 for the custom benchmark. Both of your core managers, Manulife and Owners Partners, albeit negative, they protected in a tough market and outperformed the Bloomberg aggregate in all time periods. Measure and have done very well. You drill down further. Basically, all of your managers have done a good job, and that's how you've gotten the returns you did above the policy index. We talked to Lazard already. If you'll move to the next page, Sue, so I want to give Jeff some time. PIMCO All Asset has faltered in the quarter, 2.2 versus 4.5. Didn't rank well. They're challenged over the past year. Longer term numbers, no concern in the 5-year, 10-year since inception number there. And then your two hedge fund managers, Grosvenor and Whitebox, of course, Entrust is in liquidation. Both of those managers delivered excess returns for the quarter over the past year, and the long term have added value to the portfolio. And then lastly, on the next page, you've got your managers that we actually, the Tumble funds, we actually have those and we put in for distributions in those. Interestingly enough, this quarter, both of them in a tough time for this type of investment, both protected on the downside and exceeded the return of the negative Odyssey. That wraps up basically the quarterly numbers. And if you want to turn to the back of the report, to the page 79, which is the watch list. We've already talked about Edgar Lomax, as you know, they'll be coming in. The other managers that are on watch, we have the Invesco Emerging Markets. We talked about we will have to bring them in. Exponent, we'll talk about that, when we want to bring them in. We've seen them a couple times over the last few years. Lazard has come in. We will schedule Newberger to come in. And the PIMCO All Asset Fund, we're not really concerned. If you look into the long-term numbers, are okay. but no one that we know of having any structural issues, personnel issues that would cause us pause and want to look at replacement. We do have a search in play, as you know, in large cap value as a consideration because of peer group, possibly some other large cap value managers that may deliver more return than an AgriLomax, but also take into account to know that that is a very conservative, contrarian manager. So you have to think about that when you look at how they place in their peer group. Any questions before I turn this over to Jeff to give you all a quick update on what happened in April? But this time I get to give good numbers.
I would like to say, was that Lazard that just gave that presentation earlier?
That was Lazard that just gave the presentation, and he explained what happened. And you remember your policy is a 2-year, which is not typically we look at a manager over a 3-year rolling period, but the policy is for a 2-year versus the peer group and a 2-year versus the benchmark.
Okay, thank you.
You're welcome.
Okay.
Jeff, anything you want to add, or just want to go right into the flash?
Oh, that's good. Sue, if you want to pop up the flash. So as Welda went over, it was a good quarter. And April, unfortunately, we gave a little bit back. I'll wait for Sue to get the report up here. And Sue, if you just want to flip to the first performance page. So flash, keep going, the actual fund performance. Okay. So from an asset allocation standpoint, I sort of jumped over the chart because I'm going to give you some good news on top of this not so great news. So Gwelda brings you up. I'm going to bring you down a little bit, but I'm going to try and bring you back up. So the plan was down just a little over 2% for the quarter. I'm sorry, for the month of April. And really, it's just what we've seen in the market, and why we had such a good quarter was saw some better inflation numbers. I heard the general tone from the Federal Reserve is that they might lower some interest rates at some point. And so that's what really gave the market some excitement in the quarter. And then come April, it was sort of a reversal of that. The inflation numbers ticked up a little bit, and then the Fed said, well, maybe we're going to keep rates higher for a little bit longer. Markets didn't like that. And so things sort of sold off. And then fast forward to today, where we are in May, again, an inflation number came out that, frankly, I don't think it's all that great. Thinks it was okay. And then now the expectation is back that maybe we do see the Fed cutting rates 1 or 2 times before the end of the year. So everyone's reacted favorably to that. So equity markets through May so far are up over 5%, fixed income up as well. So pretty much everything that was lost in April has been recouped so far in May. So it's been a good month, and that kind of, from an asset allocation standpoint, that Gwelda covered puts us. Would someone have a question? I'm sorry.
Yeah, I was going to say that first column, the MTH, I see all negative.
Well, Bobby, I was just going to tell Jeff, you threw Bobby for a loop because she was ready to see red, and you did not color code this, or Bobby would have been on you. And look, Bobby, you just mentioned it. They did not color code it for you for red.
That's right. They did.
So that you got away with it.
I think, the PDF creator that we had ran out of PDF red ink, so we just.
Well, that do happen. That happened. But I'm just saying, that first column I see all negative, and then the second column I see no negative. So, like you said, you took me down and you brought me up a little bit.
And I guess that's how we like to see them, and then we know how we're allocated, that we are very well diversified, and we try to keep things minimized in these down months, and hopefully we keep them to just down months and we get more positives than negatives. And you can see for the fiscal year, we are still positive. The last 12 months, just over 8%. And so, yes, a lot of positives across the board. And that's, again, just due to some of the past couple of quarters that we've had that have been very strong. Certainly what we want to see is those 5 and 10 year numbers start to creep up closer to where we see that inception number. And even that inception, we want to see higher and get a little bit more in line with our actuarial return expectation. at that 7% level. So, because honestly, that's certainly a big driving factor in what the health of the plan looks like on an ongoing basis, and how that continues to create growth and certainly ensure that everyone's getting their retirements and we're doing well. So we're very confident that we're still in that sort of position. And again, the 5 and 10 year numbers certainly encapsulate some bad periods that we've had over that 5 and 10 year period. If we take a look on a go forward basis, which we always tend to do when we look at the asset allocation of the system and understand that we're allocated appropriately, it's those forward looking numbers are good, because again, if you think of some of the negatives we've had from all of this interest rate pressure, particularly on fixed income, which is a big portion of the system, that with where interest rates are right now and when they do start coming down, and you heard this from the Lazard folks too, that on their structure, which it's riskier, it's emerging markets, but they think low double-digit returns for that strategy and sort of that base case scenario. Well, if you think of the rest of your fixed income, which is not as risky as that, but still has some pretty decent coupon yield in it, that the rest of your fixed income portfolio is still a nice moderate single-digit return, so 5, 6, maybe even 7%. For those types of portfolios, and that's again, you're getting that kind of return with not as much risk, and so that's all very positive. And that those things, plus where all of the equity valuations are as being still fair, tells us that we probably are sitting looking at a 7% plus type return for the structure on a go forward basis for the next, let's call it 5 or 10 years. So again, the forward looking assumptions are really good, but certainly it takes a couple other good months, and if we see one in May, it's going to start to bump up that 3, 5, and 10 year number as well, and get us back on the footing that we want to be. So that's really about all I wanted to cover. Not going to go into too much fine grain on the numbers. We tend to on the individual manager returns. We try to keep that saved for a quarterly basis. But again, a couple things we're keeping an eye on. Some managers that we have in to give us an update on where things are going, but otherwise, from a structural standpoint, it's things look pretty good, and I think that the outlook's pretty positive.
Okay. Bobby, are you pleased?
Yeah, Jeff, don't trick me next time. I want to see no red. Don't come up with no excuse. There's no red ink.
Correct.
Okay, Chris, you want to take us home, or you want me to take him home, or what?
I'm here. So are there any other questions, concerns?
No, I want to thank Jeff and Gwelder for that brief report.
Oh, Jesus, Bobby and Allie, thank you so much. I really appreciate you, and you're very impressive. That's all I got to say.
Thank you. Welcome to our circus.
Yeah.
Here.
And one thing we don't ever do with this board, we don't ever curse.
Mm-mm.
Except in executive session.
That's right.
And one thing I know is laughter is good for the soul.
Exactly.
Well, thank you everyone for participating, and I'm sorry I've been in and out today, but I appreciate it.
Appreciate you, baby. Don't worry about it.
And how many of us are going to NASP?
I am.
I am.
Bobby, Christine,
Sheila is.
Sheila.
Yes, Atlanta, Georgia.
All right, Doris, are you heading?
Christine, you know I don't fly.
Oh, I'm sorry, Martel.
He's not on the call anymore.
Okay.
I'll call him and see, because he just got that big position at U.S. Bank, so I don't know if he can go anywhere right now.
Okay, so Sue, anybody else did you register?
No, not yet.
Am I registered? Because they're saying they're selling out these little.
Yeah, I'm getting ready to I'm going to get that squared away right now.
Okay, yeah, I'll get everybody registered. I'll try to do that tomorrow.
Okay.
I'll see you all there, and I'm teaching a session. I'm actually on a panel.
Oh,
good.
great.
Hey.
Oh, wow. If I had known that, I would have got on the plane. I knew I wouldn't.
All righty, everyone. Thank you. Have a blessed evening.
Thank
You
you.
need to-
Aye.
And happy
Okay.
Mother's Day to all the mothers.
And
to you,
Thanks,
Bobby.
Bobby. All right,
Okay.
bye-bye.
we do need to call for adjournment.
Yes.
Oh, can I make a motion to adjourn?
Richardson
Sheila Goodwin makes
second.
a motion that we adjourn.
Richardson second.
All those in favor?
Aye.
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 Thanks, everyone.
All right,
Good
thank you.
night. Okay.
Everybody.
Good night, everybody.